they've been pretty fine throughout this entire situation. If anything, the rates give them more money, and the ongoing deficits are generally going toward Medicare, Medicaid, Social Security, defense. A lot of it is also basically an interest expense. A lot of that's flowing to the upper ends of the income spectrum as well. Whereas where that's been challenged is anyone that's younger looking to buy a home is obviously kind of pressured in that market. We see fairly low volumes across that sector. It's ongoing just sluggishness because people generally don't want to sell unless they have to, and people are kind of waiting to buy and kind of constrained from buying. And so I think that's contributing to the kind of the K-shaped economy that we see right now.
Bitcoin's mid-cycle signals are fueling renewed optimism for a bullish rally, and Lyn Alden's sharp analysis provides key insights into why this might be the case. Bitcoin has evolved from a niche asset to a growing financial ecosystem. As adoption accelerates and market liquidity deepens, its behavior has shifted to reflect its transformation into a truly global asset. Alden highlights how Bitcoin in 2025 is fundamentally different from its earlier cycles, such as in 2017. Today, it operates with much greater liquidity, driven by increasing institutional acceptance and widespread usage. This improved liquidity not only enhances Bitcoin's market stability, but also adds new layers of complexity. Cycles of profit-taking, rebalancing, and reinvestment are more pronounced, signaling a shift from speculative spikes to more balanced and sustainable growth patterns. While dramatic price surges often make headlines, Alden cautions that they can lead to destabilizing corrections that may hinder long-term progress. Instead, Bitcoin's ability to sustain steady growth, supported by its expanding market infrastructure and diverse investor base, is a sign of its maturation. More than just financial milestones, these developments mark Bitcoin's transformation into a trusted asset for wealth preservation, changing how individuals and institutions approach financial security. Alden's insights offer a clear roadmap for understanding Bitcoin's future as it continues to shape the global economy. This mid-cycle could lay the foundation for its next major rally. Have you ever wondered who the crypto advisor must be for the biggest names in the online business space, such as Aman Godzi, Andrew Tate, and Luke Belmar? Well, there's one crypto investor who was the consultant for all of them, and he actually shares the systems he gave these influencers to make them millions on his YouTube channel for free, growing an 8 million portfolio by the age of 25. Daniel McAvoy is one of the best crypto investors you'll find online, specializing in long-term investments and meme coin investing. His YouTube channel is packed with incredibly valuable videos that will help you make life-changing wealth from crypto. Start watching one of the greats today, link in the description of this video.
We have the same momentum that we had in 2024 and really much of 2023 for that matter, which is decent liquidity conditions and ongoing fiscal dominance in the US, which is leading a lot of things to run hot, ranging from nominal GDP to asset prices. And a couple of the key things I'm watching for 2025 is basically anything that would change the course of that or give us some wiggles along that path. And so one of the things I'm watching first and foremost is the debt ceiling issue. Not because I expect much out of it in the long run in terms of all the defaults and stuff that can happen, but rather because when the debt ceiling's being contested, the Treasury has to do extraordinary measures, which they started this week. And that basically means that they have to drain cash from their account back into the system in order to keep paying their bills without issuing that new debt. So the longer that goes on, that's a liquidity factor, which can then translate into asset prices and other things like that, financial conditions broadly. And then also the one of the biggest things to watch is tariffs. That's potentially an all year thing to watch, but especially in the first few weeks and months here to see any sort of announcements around that. So I get a lot of questions around what's the Fed going to do. We obviously have an upcoming Fed meeting, but in this era of fiscal dominance, I pay a lot more attention to some of these other factors, even though, of course, Fed decisions still matter. But at the end of the day, fiscal matters a lot more. Well, so historically, I mean, the debt ceiling was not used for a negotiation tool for most of its life. Ever since the global financial crisis, it started to be used more. We have a fairly small sample size of presidents since then, and most of those president terms have been Democratic presidents. And so it's mostly a tool that Republicans use against Democratic presidents. We didn't really see Democrats use it against Trump in his first term. And now we might see Republicans use it against Trump. But to answer your question, my base case would be to see not very long because of that, the fact that it's all intra-party. and he's got a very strong position within his party, kind of culturally, and in terms of allies. So um, if this were to go on, kind of as the 2023 debt ceiling did, and then I believe the 2021 debt ceiling, it could potentially go 5 months or so, kind of be a dominant factor for much of the first half of the year and drain that 600 billion plus back into the system over the course of the better part of half a year. Um, that's basically if you leave it as it is now, no ability to lift the debt ceiling, ongoing disputes, and then they have an 11th hour fix to it like they've done prior. That's kind of what would happen. But I expect it to get handled more quickly than that because of the fact that it's all intra-party. So it's something that I don't think all that liquidity is going to get drained in the system, but until we see progress on the debt ceiling, the TGA will start, gradually draining back in. So if you back up a little bit, back in 2022, that was a very negative liquidity year. The Fed was draining liquidity, and also the Treasury was not really providing liquidity. But ever since we saw the issues in 2023, partially around regional banks, but then also the rising yields and things like that, we started to see the Treasury increase its issuance of T-bills, and that allowed them to suck liquidity out of reverse repos and back into the system. And so really for about 2 years, we've seen the Treasury almost perfectly offset the Fed in terms of liquidity. So the Fed's still doing quantitative tightening, but the reverse repo facility is draining back into the system at almost exactly the same pace. Um, and so when you kind of look at aggregate measures of domestic liquidity, it's been almost perfectly flat. It just kind of trends sideways ever since 2023. But that's got a time limit to it, which is there's only so much left in the reverse repo facility for that to happen. And the last 2 quarters, we have seen increasing amounts of kind of strain under the surface. So the repo facility was tapped in quarter 3, window dressing, and then it wasn't really tapped in quarter 4, but we saw kind of initial funding stress leading up to it. Basically, it was expensive for different institutions to get the liquidity they needed during window dressing. If we take the TGA out for a second, we probably should expect that by mid-year or so, we run into some, pretty serious liquidity constraints in the system. We'll get kind of updates probably each quarter to see what does funding stress look like. Did anyone have to tap the repo facility, the Fed's repo facility, and things like that? But yeah, most indicators show that we're kind of pretty close to the liquidity floor in banks. And the Fed's probably going to go back to, not doing quantitative tightening this year at some point, and either have a flat balance sheet for a little while or go back up to kind of gradually increasing their balance sheet, only in terms of treasuries, while probably continuing to let off mortgage-backed securities from their balance sheet. And if you bring back in the TGA for a second, that could extend the current situation a little bit if the TGA does end up draining entirely into the system. And then you'd have issues when they go back to refill it. Now, still not my base case that it's going to be drained, but that's more of a political question. So that kind of does throw a curveball into things for the first half of the year. But either way, by the second half of the year, we're probably going to see liquidity constraints in the system.
The debt ceiling debate is more than just political theater, it's a financial tightrope walk with ripple effects on liquidity and market. Lyn Alden explains that as the U.S. Treasury draws down its cash reserves during a standoff, liquidity temporarily surges, boosting asset prices like Bitcoin. However, the eventual need to replenish funds could tighten liquidity, creating market turbulence. While intraparty disputes are usually short-lived, this showdown highlights the delicate balance between political decisions and economic stability, with Bitcoin closely tied to the outcome. Bitcoin thrives at the intersection of liquidity cycles and global monetary policy. Alden emphasizes Bitcoin's correlation with liquidity, where domestic policies like quantitative easing and global dollar strength play crucial roles. Despite global liquidity pressures, optimism has surged with pro-crypto developments, including the potential for a U.S. Bitcoin reserve. On-chain metrics such as market value and long-held coins indicate a mid-cycle phase. Alden remains bullish, forecasting Bitcoin's resilience and growth over the next 12 to 24 months amid fiscal dominance and evolving market dynamics. Let's watch more clips from the interview.
So I think it's partially why there's a disconnect between kind of the wealthy and the less wealthy, or the asset owners and the non-asset owners, because anyone who entered this period with a lot of assets and with a home, either that they own outright or with a fixed rate mortgage on it, they've been pretty fine throughout this entire situation. If anything, the rates give them more money, and the ongoing deficits are generally going toward Medicare, Medicaid, Social Security, defense. A lot of it is also basically an interest expense. A lot of that's flowing to the upper ends of the income spectrum as well. Um, Whereas where that's been challenged is anyone that's younger looking to buy a home is obviously kind of pressured in that market. We see fairly low volumes across that sector. It's ongoing just sluggishness. Point to the kind of ineffectuality of the Fed here, because if you just kind of back up and say the Fed's tools to manage inflation are almost entirely geared around bank lending and exchange rates, basically. So if they raise rates, the goal is to kind of slow down bank lending, make borrowing more expensive, and also to harden your currency compared to potential foreign currencies, so foreigners don't pull money out of your economy. So those are kind of the two levers. But in the current era, this entire 2020s period, we never had excessive bank lending. Bank lending was not the driving factor of inflation like it was in the 70s. And instead, we had monetized fiscal deficits. And raising interest rates doesn't do anything against monetized fiscal deficits. Now, they can push back on monetizing it to some degree. But at the end of the day, if they see dysfunction in the treasury market, they always step in to fix it. And so their tools are not really geared around that. And that's why it's ultimately more of a fiscal thing. Now, the Fed they can kind of indirectly tackle that by saying, well, if fiscal is running hot and is therefore contributing to inflation, we can run bank lending at below average to try to offset it. We can say, okay, if bank lending is normally at X, we can slow that down to maybe run at 70% of X. So you have a little bit sluggish bank lending and therefore slow down money creation that way. But then all you really do is shift where the driver of the economy is. You're almost kind of like unfairly slowing something down because fiscal's running hot. And so that's kind of the big challenge that they face. And it just kind of shows that the whole model doesn't work as well as it's kind of intended to when you have fiscal dominance, which is why this period is kind of just structurally, we need different ways of thinking about it compared to how we analyze markets for much of the kind of the past 40, 50 years. I think that the main moving parts there are if we had gotten a Harris victory, then we would have had to more seriously consider some of those Trump era tax cuts expiring, going back into effect, which would have been effectively a tax increase. Now, because we get the Trump victory, those are less likely to be allowed to go back in. They're more likely to be either extended or made permanent in some fashion. And so that's basically all else being equal, a deficit contributor. But then on the other hand, now we have to seriously consider tariffs to some degree. And those are tricky because to what extent are they taxes on the American people versus taxes on foreign businesses? The proponents of tariffs would like to say that it's going to come out of the profit margins of the foreign producer. But a lot of, especially physical goods, a lot of profit margins are 10, 20, 30%. So if you put 20% tariffs on someone, they're either going to not sell to that market or they're probably going to increase prices to some degree. And so we could see additional revenue from I believe they call it the external revenue service. So that could balance it out. I still think tariffs are one of the biggest things to watch because we don't know the magnitude yet. We've seen kind of the opening statements, kind of what the initial side of the negotiation. But where do those actually land in practice? Really remains to be seen. I generally would take the under, just because I think it's an administration that'll be very careful of market disruptions that are abrupt, but we'll see.
The cryptocurrency market is showing an intriguing mix of momentum and caution, with Bitcoin trading between $100,000 and $119,000. Retail on-chain activity for transactions under $10,000 has dropped by 19.3%, indicating subdued participation despite Bitcoin's strong performance. Google Trends data reveals that searches for Bitcoin and related terms have increased year over year, but they are still well below the euphoric levels seen in 2021. Events like the launch of Trump's meme coin, which briefly surged to a $15 billion market cap before dropping 55%, demonstrate how short-lived excitement drives retail engagement more than sustained rallies. Lyn Alden's analysis provides valuable context for these trends within broader macroeconomic dynamic. She highlights Bitcoin's correlation with liquidity, explaining how factors like quantitative easing, fiscal dominance, and global dollar strength influence its price action. While retail interest may seem tempered, Alden notes that Bitcoin remains closely tied to liquidity cycles, which play a pivotal role in its midterm performance. She also points out the mid-cycle structure of Bitcoin's on-chain metrics, suggesting potential for growth without being overstretched. Alden's insights underscore Bitcoin's resilience and strategic value amidst these dynamics. She predicts that fiscal policies and liquidity trends will likely continue to support a bullish outlook for Bitcoin over the next 12 to 24 months. As Bitcoin evolves into a more liquid and strategically significant asset, these trends emphasize its growing role in a world marked by economic uncertainty and shifting financial priorities. As we wrap up, how do pro-crypto policies, such as the potential U.S. Bitcoin reserve, shape Bitcoin's future adoption? Let us know your thoughts in the comments below. For more Daily Dose Crypto news, check out these 2 awesome videos on your screen. Click now and we will see you on the next video.